John Bogle, the founder of Vanguard and the pioneer of index investing, transformed the world of investing by simplifying it. His ideology, grounded in the principles of low costs, market efficiency, and long-term thinking, provided a roadmap for investors looking to build wealth without succumbing to the noise of short-term speculation and high fees. Bogle's belief in the power of compounding, simplicity, and the resilience of the market became the foundation of his investment philosophy. In this article, we explore Bogle's core principles, the revolutionary impact of his ideas on the investing landscape, and why his wisdom continues to resonate with investors across the globe. 1. The birth of index investing. Before Bogle's innovation, the investment world was dominated by actively managed funds. These funds relied on stock pickers and market timers to outperform the market. However, it soon became evident that the vast majority of fund managers struggled to consistently deliver returns above the market average, largely due to the high fees they charged, frequent trading, and emotional decisions based on market trends. In 1976, Bogle revolutionized the investment world by creating the first ever index fund. Unlike actively managed funds, index funds aim to mirror the performance of a broad market index like the S&P 500 without trying to beat it. Bogle's insight was that instead of attempting to outperform the market, a nearly impossible task for most, investors could simply match the market's performance at a fraction of the cost. This concept, which seemed radical at the time, democratized investing by allowing anyone to benefit from the market's long-term growth without the burden of high fees or active management risks. 2. The power of low costs. John Bogle's unwavering focus on minimizing investment costs is one of his most significant contributions to the world of finance. He highlighted how the high fees associated with traditional mutual funds, ranging from 1% to 2% annually, diminish investor returns over time. While these fees might seem small in the short term, compounded over several decades, they can have a devastating effect on an investor's wealth. Bogle's solution was simple yet powerful. Index funds, with their extremely low expense ratios, often as low as 0.04%. By keeping costs down, investors could retain more of their returns. In his own words, the stock market is a giant casino where the house, fund managers, takes a cut of your winnings. The lower the fees, the more you keep. This principle of cost minimization remains a cornerstone of Bogle's ideology and continues to benefit investors worldwide. 3. Long-term thinking. The key to wealth. Bogle's belief in long-term investing was perhaps his most enduring message. In an age where instant gratification and speculative trading were the norm, Bogle advocated for a patient, disciplined approach. He warned against market timing and chasing short-term trends, asserting that true wealth is built over time, not through quick wins. His famous quote, "Time is your friend, impulse is your enemy," encapsulates his philosophy perfectly. Bogle encouraged investors to invest consistently, regardless of market conditions, dollar cost averaging, tune out the daily market noise, avoid the temptation of hot stocks or fleeting trends, reinvest dividends to harness the power of compounding. Bogle firmly believed that the key to success wasn't about chasing the next big opportunity, but rather about staying the course through market ups and downs, allowing time to work its magic. 4th, diversification. Managing risk, maximizing returns. Diversification was another critical element of Bogle's investment philosophy. Rather than concentrating on a small set of stocks, Bogle advocated for broad market exposure. By investing in a diversified portfolio, such as an index fund that tracks the S&P 500, investors could spread risk across hundreds of companies, ensuring that even if one company or sector underperformed, the overall portfolio would still benefit from the market's growth. Bogle's approach contrasted with the riskier tactic of investing in individual stocks, where the potential for both high returns and devastating losses was more pronounced. Through diversification, Bogle argued, investors could capture the collective growth of the economy while minimizing the volatility associated with individual stock picking. 5. Ignore market noise and speculation. Bogle was a staunch critic of the constant stream of market predictions and economic forecasts that dominate financial media. He argued that most of the market noise is designed to distract and confuse investors, pushing them to make emotionally driven decisions that often lead to poor financial outcomes. He believed that the best strategy for long-term investors was to ignore the sensationalism and stick to a simple, well-thought-out plan. The stock market is a giant distraction from the business of investing, Bogle famously said, cautioning investors against the dangers of reacting to every market fluctuation. Bogle advised investors to resist following hot stock tips, avoid reacting emotionally to market crashes or booms, ignore speculative bubbles like cryptocurrency or meme stocks, steer clear of attempting to time the market. For Bogle, the most successful investors were those who remained calm, ignored the noise, and stuck to their long-term strategy. 6. The magic of compound interest. Perhaps Bogle's most profound belief was in the power of compound interest. Bogle understood that small, consistent investments over time could lead to remarkable wealth. By allowing investments to grow without interruption, avoiding the temptation to trade frequently, investors could maximize their returns through the magic of compounding. For example, if you invested $500 a month in an index fund with an average annual return of 8%, in 30 years, you could see that investment grow to over $1 million. Bogle's mantra, "Don't interrupt the magic of compounding," encapsulated this powerful principle. The longer your money stays invested, the more it works for you. 7. The impact of Bogle's revolution. Initially, Bogle's idea of index investing was met with skepticism. Many critics argued that investing in a fund that simply mirrored the market was settling for average returns. However, over time, index funds consistently outperformed actively managed funds, proving Bogle's philosophy correct. Today, index funds are ubiquitous. Over half of U.S. stock investments are in index funds, and Vanguard manages over $8 trillion in assets. Index funds save investors billions of dollars in fees every year, and they have democratized investing, giving ordinary people access to the same benefits that were once reserved for institutional investors. 8. Criticism and challenges. Despite the widespread success of index investing, Bogle's philosophy has faced criticism. Some argue that passive investing could lead to market inefficiencies, and others contend that it stifles the potential for individual stock-picking brilliance. However, Bogle consistently defended passive investing, stating that it reduces speculation, lowers fees, and ultimately provides better long-term returns for most investors. 9. Bogle's timeless advice. Before his death in 2019, John Bogle left behind a simple yet powerful set of principles for investors. Invest in low-cost index funds. Stick to your long-term plan. Minimize fees as much as possible. Diversify across the entire market. Ignore short-term market fluctuations. Reinvest dividends to maximize compounding. As we bring this article to a close, it's essential to reflect on the enduring principles that form the backbone of John Bogle's investment philosophy. In a world filled with complex financial strategies and high-risk approaches, Bogle's ideology stands out for its simplicity, effectiveness, and long-term focus. His groundbreaking contributions have reshaped the way we think about investing, making it more accessible, affordable, and successful for everyone, regardless of their financial background. In this summary, we'll take a deeper look at the key elements of Bogle's approach, which emphasize low-cost, diversified investing and the importance of patience. These principles have proven time and again to be the cornerstone of sound financial planning and have left a lasting legacy in the investing world. Let's now summarize the key takeaways from his philosophy and why they continue to inspire investors to this day. John Bogle's investment principles offer timeless wisdom for anyone seeking to build wealth for the future. His approach of low-cost, diversified investing and long-term thinking remains relevant in today's fast-paced financial world. If you found this article helpful and want to dive deeper into more financial strategies, be sure to like, subscribe, and hit the bell icon to stay updated on our latest content. We'd love to hear how Bogle's philosophy has influenced your investing approach. Have you already applied any of his principles in your own financial journey? Let us know in the comments below. Stay tuned for more insightful tips and strategies that will help you make smarter financial decisions and grow your wealth in a sustainable way.